This will be the busiest week of the fourth quarter earnings season. Next week will also be jammed with earnings releases, and that means this is the season of the stock picker. Just this week alone, there will be companies comprising about 35% of the S&P 500's market cap reporting quarterly results. Just Wednesday alone, we will have Microsoft, Facebook, AT&T, Boeing, McDonald's. Other big names for Thursday will include Amazon, Visa, Verizon, Coca-Cola, and Amgen. One of the most highly anticipated reports will be from Tesla, which will come Wednesday at the close, but Tesla isn't even part of the S&P 500. With all of the results coming fast and furiously, we should expect at least a bit of volatility. But with stocks priced to perfection, we also have to deal with the coronavirus, the Senate impeachment trial, and the recent attack from Iran. So, let's take a look. Going into next week, we will hear from over 40 companies in the S&P 500, and data from Bank of America Global Research indicates that as the number of companies reporting earnings increases, so too does the market average performance dispersion. Stated another way, the more companies that report earnings, the wider the gap is between how an average stock trades relative to the broader market, as you can see in this chart here. And as expected, the more companies that report earnings, the more volatile the average stock is according to Bank of America Global Research. This really shouldn't be a surprise, as just about everyone can see this. Corporate news can always be a stock mover, and earnings reports are generally a guaranteed way to move a stock. However, something interesting is appearing with respect to the volatility expectations. Bank of America notes that the dispersion in the analysts' estimates is currently near its lowest level in nearly 2 decades. What this indicates is that the analysts have not been sharpening their pencils. Instead, it appears the analysts have been simply following corporate guidance and broad Wall Street models. As Bank of America states, consensus estimate dispersion has been near record lows, which we believe is driven by heightened macro uncertainty, causing analysts to be more hesitant and avoid deviating too much from company guidance. Bank of America indicates that for the S&P 500, dispersion currently sits at 6%, up slightly from 5.7% last quarter, which was the 18-year low. It is well below the long-term average of 9.5%. If low dispersion reflects a reluctance to diverge from the pack, focusing on out-of-consensus earnings calls should be rewarded. As you can see from this chart, analysts' estimates for quarterly earnings are about as close together as they've been in nearly 20 years, according to Bank of America data. And with these kinds of conclusions, the market often will reward investors willing to bet on outside of consensus earnings outcomes. So these 2 weeks offer investors the best chances we'll see for months to reap these rewards. I half expect the opportunity to be relatively short. Remember, we got to this point on the coattails of the Fed liquidity. Given that the liquidity remains flush, even with stock market issues like the coronavirus, the impeachment trial, and other distractions, I expect the Fed to remain involved. Ironically, I expect the Fed's safety net will prevent a major sell-off, even if, or rather especially, if the coronavirus epidemic results in a collapse within the economic supply chains. So, just another day in the bizarro world of the new normal. And for today, that's ChewDog Charts. Thank you.